I think the big test though is going to be around product quality. It's much easier to build apps than ever before, without a doubt. 5 years ago, you could give a founder $20 million to hire engineers, and they can go hire all the best engineers. And if they don't have great product intuition and product taste and like a process for building a great product, then they're just going to light $20 million on fire, right? Like it's not going to matter. The phase that we're in now is the number of high quality apps is still bottlenecked by like product taste and judgment. And part of what I'm personally excited about is ways in which we can use AI to make people better at creating products.
Hello, I'm your host, David Bernard. And with me today, RevenueCat CEO Jacob Eiting. Our guest today is Andrew Maguire, managing partner at Volo Ventures, an early-stage venture capital firm investing in pre-seed and seed-stage startups founded by exceptional builders. On the podcast, we talk with Andrew about the bootstrapper's path to 10 million in ARR, what's actually investable in consumer in 2026, and why product taste is the new bottleneck, not engineering. Hey, Andrew, thank you so much for joining us on the podcast today.
Hey, David, thanks for having me back.
And Jacob, nice to have you.
I'm also here on the podcast, David. It's good to be here.
I forgot to say hi to Jacob on the last podcast, so we were just joking about that. But anyways, Andrew, super excited to have you back on. And I wanted to kick things off with just your perspective as an investor in consumer businesses. So you're probably one of the few investors I know anyway that operated a subscription app, a consumer subscription app, and is now doing venture. So just started at a super high level. Like how are you thinking about consumer these days and investability and things like that? And we'll kind of chase those threads.
Yeah, sure. In general, I think it's just a super exciting time, right? Because what we can do with AI is so compelling compared to what was possible even a few years ago. I think what I'm seeing from an investor perspective is obviously like tons of founders are chasing the enterprise, right? Like these are big markets, like big opportunities, a lot of attention is going there. But I think it's very intuitive to me and probably to you guys as well that, the way that we build consumer products is going to change a ton with AI and become much more powerful, much more personalized. So I'm very excited about that. I think there's a ton of opportunity. There are definitely like some things to avoid along the way if you're, depending on what kind of business you're trying to build. But generally speaking, I think it's a super exciting time for a consumer.
Yeah, we were just talking before we hit record about Jacob's got an OpenClaw setup. I have a Hermes setup. Like the actual act of building a consumer app these days is just light years different than it was even 12 months ago. And then that's just on the building side. And then kind of what you were alluding to, the kind of experiences we can now build with AI is just a whole new ballgame. And I do feel like, we're 18 years into the App Store, but it feels like a whole new beginning with these AI capabilities of building all new experiences and all new apps and all new opportunities.
You guys are publishing this data on how many apps are getting posted to the App Store. And, obviously a lot of them are using RevenueCat, which is awesome. I think the big test though is going to be around product quality, right? It's much easier to build apps than ever before, without a doubt. But I was sort of thinking the other day about how 5 years ago, you could give a founder $20 million to hire engineers, and they can go hire all the best engineers. And if they don't have great product intuition and product taste and like a process for building a great product, then they're just going to light $20 million on fire, right? Like it's not going to matter. And so I think the phase that we're in now is the number of high quality apps is still bottlenecked by like product taste and judgment. And part of what I'm personally excited about is ways in which we can use AI to make people better at creating products, right? Because I don't think the one-shot app is going to really work long-term. Just
like
like,
gonna rise above, right? It's tough to like not deal in anecdotes because I think every individual's like slice of like what apps are you using, right, is very hard. Are there any apps that have entered your guys' personal lives in the last 18 months that you can be like, oh, this was vibe coded? There's one that I can think of. I'm gonna plug. I don't know if we've talked about on the pod yet. Is ATC, which is a really cool app. If you haven't tried, it's like an iteration on listening to air traffic control. It's built by a very, very small team. I know for certain it was like very not vibe coded, but very AI assisted. And it's a good example of like how certainly with the ambition of that project wouldn't have been achievable pre-AI and is now. But again, it's like they probably could have done that before the current world because like, yeah, to some degree, almost the money and the engineers it's expensive, but it was like attainable, right? Versus the taste and intuition to build a really great product. I don't know if you can't necessarily like go to Sandhill Road and like get that, right? It's a more rare thing. I'm constantly going back and forth on like where the actual new bottleneck is. I initially I was not on the board of like, oh, it's like if we have like a taste product understanding bottleneck. I thought that was like a lot of like sort of elitism and thinking that like it mattered that much. But the reason I've moved on that is that I think the noise has gone up so much and like there's just so many options now that like almost the only way to differentiate is by having something that's like stands out. One, it's a great product, but two, then to really grow, your quality of your product will drive down your cost of acquisition, which will then ultimately allow you to reach more efficiently a larger scale.
another way to think about this is if you're a pre-product market fit company, more engineers is not necessarily going to accelerate your path to product market fit, right? There are just so many different like product decisions and design decisions and like, are you talking to users and are you doing all this sort of stuff? I think vibe coding is going to be very successful. And certainly like if you do have good product intuition, it's going to make you so much faster, right? I mean, that's where I think the most leverage is right now. What I'm more skeptical of is the like one shot the app type approach.
I think just like turning your OpenClaw on and being like, come up with app ideas and publish them. You don't think that's gonna like make
build me a great personalized fitness app and like here's a couple other sentences because there's just too many decisions to make, right? Yeah. So
well, I don't know. It's like AI is good at making decisions. It's again, it's a stupid word, taste. It's just like it doesn't know what information to actually consider versus not that exists. If the context is not exquisitely prepared in text for it, it's a very hard time to kind of like understand that. And like, okay, so like I have certainly seen AI in my work come up with novel ideas. Like that is not, I didn't know if that were the case like 12 months ago, 24 months ago. Like, oh, can AI not just like regurgitate things it's already seen? It does seem like, at least in terms of novelness, coming from like the recombination of existing factors, right? Which is like a big part of creativity, right? But like, I still am not sure that it knows how to like choose the best. It can come up with 8 ideas. I asked like app ideas yesterday from AI, and it was honest. I think it was ChatGPT 5.5. But like, honestly, I was really impressed. I was like, oh, like 2 of these 5 are really great, but like, they're not really great, but have potential. Like, I've heard a lot of app pitches in my life. Like, so I have some, like 2 of them, I was like, oh, that's actually like, this is viable, right? It's not just like a personal CRM or whatever. But it's still, I don't know if it has like, and I do think it goes down to like the drive, intuition, taste, to like pick one, actually drill into it, actually like have conviction to like, and I guess this is where the human and the exceptional human like still plays a huge role, which is like when the agent, the model doesn't spit out the exactly great product the first time, they sort of have the missing factors to look beyond that to like solve the bottlenecks and stuff. I think the question I'm still in some ways grappling with is just like, how do these like competitive dynamics change what it means to like, even I guess from a cash perspective, invest in the app store or in apps and like consumer And I think there's also, David, you kind of brushed over at the beginning, but there's, I think, a big difference between like consumer and like app store consumer or CSS, right? Like we talked about, you're talking about Zoho Computer and Hermes and OpenClaw, and like those are all consumer products, right? But they're not like app store products necessarily, right? Yeah. There is a bit of a difference, and I think it's worth differentiating. I've seen a lot of consumer investors actually kind of pivoting away from the like app store as this like primary software delivery thing and like sort of broadening. Like ChatGPT is a consumer product. It's one of the most successful consumer products in history. It is on the App Store, but I would not consider it like an App Store story, right? Like it's in part an App Store story.
When you asked like what apps have you adopted recently that are vibe coded, I was like flipping through like the first few pages of my iPhone, like thinking, okay, what examples do I have? 0 vibe coded, but multiple AI assisted. But it's kind of to your point. The 3 I came up with were Whisperflow, which is kind of more B2B, but is an incredible consumer. I'm paying $20 a month for it. ChatGPT and Claude. And those three
which to say they're not vibe coded might be wrong because I think they might actually be good examples of the initial deployment of vibe coding.
I think it's just back on this whole vibe coding thing. I was talking about taste and judgment. I think it's also just like a point of view, right? Like there are so many different little product decisions that go into making an app. Like we have a portfolio company called X1, and it's basically a vibe coding app. But instead of trying to one-shot the app, what they do is they break down every component of the app creation process, and they figure out like what are the actual decisions that you need to make throughout the course of onboarding or throughout the course of, like major features or throughout the course of like figuring out your brand and design. And the reason that I like this is, one, it just makes it much easier to like maintain an app over time because you have these like, discrete modular parts of the app that you can go and adjust. But also I think there's this opportunity to educate people on how to create products. Like these are the sorts of decisions that you should be thinking about. Like now that we bring the cost of actually building down so low, if tools can really guide people through the critical decisions, not necessarily make them for them, or maybe give them like, here's what we would recommend, but like actually force the app creator to wrestle with like a hard question around trade-offs, right? Like that I think is the path to getting from, apps built faster with Claude or Cursor or whatever to like a vibe coded app that a non-technical person can actually make, app store ready and scalable.
Yeah, we did this essentially, this has been a big part of RevenueCat shtick. It's like we're a billing infrastructure, but then like, this podcast, like a lot of what we do is about actually like how to educate folks on monetization and the practice more so than like the technology, at least like outwardly facing, which is true. It's unknown exactly what direction the model companies are going to take it. But so far, both OpenAI and Anthropic and to some degree, most of the other ones have intentionally, out of like safety reasons, basically made these models very, like you mentioned, point of view. They've kind of intentionally coded out the point of view. Like they don't want them to have a point of view that would be like unaligned, right? And actually, sometimes in their attempt to align or make them not have a point of view, it in fact gives them a point of view, right? Which is like hyper neutrality or an attempt at hyper neutrality. But that's sort of by design. And so like, will we ever get to the point where an agent or like a model like isn't designed that way, is designed? I've never seen, but I've heard, I don't know if this is true, but they say like when a model comes out of pre-training, so you have this like pre-training step where they just like gobble down the entire internet. And then you have this RLHF step where like they basically give it ChatGPT style questions, and then they like they give it a reward if it answers them in a good way, and then they retrain the model based on that. So there's like 2 phases. And I've heard like when the pre-train gets done, the model just sounds kind of like, forgive the phrasing, but like a schizophrenic, like somebody is just like sort of babbling and crazy. So there's a lot of rawness to it. The intelligence is in there, but like it's very raw. And so like I think the model companies actually kind of have a lot of control on sort of like how these things end up expressing themselves. And so like long path to kind of go like, I don't know if that's forever, if that's even a limitation, that these things don't have a point of view. Now, an entire model that has a single point of view, about fitness apps or something doesn't seem like all that, all that useful to the world. So I don't know if they would ever build it. With the current flavor of the way these models are built, it doesn't feel like they're going to subsume sort of like the human impetus to build things, which I think is where like outlier consumer stuff comes from.
Yeah, the point on neutrality is interesting because it's kind of like this idea, it's like there's no such thing as objective history, right? It's like
right, yeah, it's written by it's whatever's in the training set, which is written by the victors, right?
Everything that's an evaluation is like a point of view.
I think they've actually done a pretty good job. And I think it's actually what makes the models kind of annoying to work with sometimes. It's like they're just so milquetoast and like unopinionated, or like anodyne is maybe the right word. I don't know. They just make these like points that are like kind of obvious, and they feel like they've discovered something very critical, like very important when you talk to them. And it's like, okay, this doesn't work. That's fine for my private conversation with Claude, but like for a marketplace, like an app store, like people aren't going to be like, oh my gosh, yes, what an observation. Let me download this app and make it part of my life. It's not going to work with humans at scale.
I think it's more about the intelligence and the context to help unlock like a human point of view. I think that's sort of a way that I would think about it. And the more that we can use AI to accomplish that, then that gets interesting.
And I think this is kind of the big question hanging in the air as to whether like consumer mobile goes away and just gets subsumed by the big model players. Because like there's a path that some people predict that like, OpenAI will just be your everything app. And so you want to track your fitness, you just say like, hey, I'm working out and I want a good plan, and it generates your plan and it tracks your everything. And like, it's hard for me to take that big of a leap. But to your like reinforcement learning point, Jacob, I was actually talking to somebody from one of the model companies when I was out in San Francisco for WWDC, and asking them like, why aren't the models better at animations and taste and things like that? And, can't you just train on like all the apps of the App Store? And then, does that mean that these models can just spit out like the best apps ever? And they said something obvious in hindsight, but actually quite insightful, is like garbage in, garbage out. Like you can't just train on everything. Like you need.
Yeah, there's a lot that goes into selecting what's in the training sets, right?
And what they need is, and this is what Anthropic has done so well with the taste of its model, and like why it's better at writing than other models and has a better personality, is they have they have psychologists and great writers and others in that reinforcement learning step in order to help guide the model to be more personable, to be more empathetic, to write better, to all these things. And so in that conversation, and just generally, I don't think it's a big focus of the model companies today to get a bunch of like mobile product people into a room and like have them doing RL, but it may get to the point where they start doing more of that, and maybe, but and like, as they go that direction, it will at least get better. I don't think it. Yeah. I still have a really hard time seeing a future of like non-human in the loop building really fantastic, great apps.
But
I think it'll get better.
Yeah, like I look at some apps we've gotten to know, especially in the fitness space, like Ladder, Gravel. Like there's some really good, and I think what makes them really great, the products are good. Like I've used many or all of them. They're different strokes to different folks. They do things differently, and then that opinion is like something people like. But there's a lot of brand involved too. It's like Coca-Cola. I mean, I don't want to, it is not Coca-Cola and Pepsi, because I think there's more differentiation in these apps, but like to some degree it becomes, what is the association? What is the brand? Who are the people behind it? More so than exactly like the features. Like all of these apps will tend to have a comparable set of features at the limit. I don't know if this is right analogy, but there's a lot of like classified websites that aren't Craigslist, right? It doesn't have to come down to the features because Craigslist is Craigslist. There's a lot of soda companies that aren't Coca-Cola, right? It just comes down to a lot of factors besides like exactly what it does. Andrew, what are you using for your fitness apps these days?
I use Strava.
Still that's like a 15-year-old app or older. Like Strava's from like the late 2000s.
This is the power of utility, right? Strava and chess.com. I might be like 40-year subscribers to those apps.
That's almost a more interesting bear case for consumer software investment and sort of dynamism than anything else, because it's like, is chess.com ever going to be replaced or need to be replaced?
No,
right?
But this is the power of network effects, right?
Right. I guess I'm putting you on a spot. Would you ever invest in like a new, like I've got a new chess app that I'm building that I think is gonna?
No, but I would be a customer of one, right?
Yeah,
so I think
invest with your time, just not your LP's money.
I need more integration capabilities from vibe coding tools to be able to do it, because
I need
I need to use
shipandapp.com.
Oh, will you be my
everything?
Will you be
I'll be your
partner?
I'll walk you. I'll help. I'll probably work with my friend Claude, but I'm sure we can get you there.
This brings up a great point, right? So like network effects, that's where a ventured back business makes sense. But there's probably like a bunch of chess apps that I would pay for as a customer that could like bootstrap and build $10 million a year businesses, right? Solving some niche problem. And to me, that's an extremely exciting use case for the App Store right now. Just like,
yeah, it gets to the question about like capital, basically, and like different types of capital, what the risk profile is, and like what the right funding mechanism is. And we've talked about this, I think, probably since the beginning of RevenueCat. When RevenueCat started, like it was much more common to see venture capital style investments into early stage apps, right?
Yeah.
I don't know if you would challenge this, but it definitely feels like 10 years on, it's much less common than it was.
100%. Right. And the reason is very simple. It's a recurring revenue problem.
Yeah. The churn's high. Right. For most of these, right? Maybe to some degree, I think the expectation on outliers was higher. Like there were a few cases of some like early, chess.com might be in that, Strava's in that example, like companies that really reached like venture scale. Maybe there was some overestimation on how easy that was or how common that would be. Maybe that some of them, I wouldn't say stalled out, but like some of them got stuck at like small public scale.
Yeah.
I don't know.
The $100 billion, like the $100 billion company, that
has yet to exist, right? In the consumer level.
Or it's like, there's the handful of, like TikTok and social products. Yeah.
Yeah, but literally a handful. There's like 10. Yeah. Less than 10, there's 5 maybe. I don't know where like Duolingo's market cap is today, but it's probably in the single low double-digit billions, I would think.
Yeah, it's right? Like 4 to 5.
Yeah, which is venture backable, but maybe not as easy in 2026. Like he went with the $100 billion outcomes. Right?
But there has never been a better time to like indie developer a $10 million app, right?
Yeah,
right.
Like what you can build. The like everything that RevenueCat offers to like on the infrastructure side, and then like, okay, paid UA, use RC capital for working capital,
pull forward,
and like build really high quality niche products.
And some of them will break out and cross a 10 million a year threshold, and then cross 100 million a year threshold.
Yeah, but if you think about the dynamic before, right? Like in order to build company, you needed to raise venture.
Yeah.
And then the VCs are going to be like, how are you going to disrupt chess.com's network effects? You're not going to be able to. So then you can't raise that money. And so then like you can't.
Or you can raise like a very small amount. Like maybe you can get like a pre-seed seed if you really try hard.
Yeah, maybe. But now like there's a very clear lane to build those products super cash efficiently. And I think, as the tools for like making these product decisions get better, I think that's going to be really exciting.
I think this is a pattern in capitalism, just generally. And we're seeing it in software, which is like when a new field emerges, often the input costs are very, very high. The returns are also very, very high. So you can attract this class of capital, which venture capital is not, it's not like a modern concept. At the scale it is, it's very modern. But there, you can go back to like the Dutch East India companies. So like these like trade companies in the 1600s. It's like the first kind of venture where you would raise money and go like try to make a bunch of money back, which doesn't exist anymore either. Like venture capital, like whatever form it comes in, is a transient phenomenon in an industry where it's like underdeveloped, costs are high, it's very speculative. But when an industry develops and like cost inputs change, it's like both the reward and the like requirement drift, and like that capital. And I'm curious, Andrew, if you agree with this. Is like that feels like the capital, at least in the last couple of years, has drifted to the AI build out. Like basically every venture capital dollar just about needs to be directly in the AI build out or attached very direct, like close to that. For one, that's probably where the outside returns are going to come from in the next 5 years. But then also, to your point, the need's just not there. Like I don't think anybody can come to you and say like, hey, I need $10 million for my chess.com alternative, because it's like, why? Yeah. Like you actually don't need that.
We've been dancing around it a bunch, but I do want to get your take, Andrew, directly on like what is investable in consumer in 2026.
For me, it's like you need to have a credible path to building a low churn product, right? So like network effects, utility, and in some sense, these are the same. I think it's probably much easier to build a really great utility product in the age of AI because AI can use personal data so much more effectively, and it can get so much better over time. So like that's one lane that I think is,
which used to be a very elusive thing, right?
It used to be very elusive. I mean, it was sort of talked about, but like, is it really like
to actually build that was very challenging.
Thinking about a product that is going to be much better for the user in 2 years or 3 years than it is when they first started using it, not because of the promise of like more features being shipped, right? But because of the usage
lock-in. Yeah, usage lock-in. So, I was talking to somebody on Twitter about Picture This. It's like a plant identifier app. And somebody was talking trash, basically the counterpoint to what you're saying, Andrew, which is like, why would you pay for this utility? All it does is identify plants. But I'm a daily active. I have a big plants growing at my house that I'm monitoring. And like, I have years of data in this stupid little app. But I'm like a DAU probably forever now, which to your point is like churn combative, right?
Well, and think about like something like anything around health or anything around finances, like these things, these topics that are very dynamic. There's always new data. There's always like adjustments that can be made. Anything where you would say to yourself, if I had a personal full-time coach for this thing that had access to 100% of the information, that would be immensely valuable. Like a personal nutritionist who actually knew everything that I ate and like knew everything that was in the kitchen or whatever, or like, and then can see the record over time and like learn your strengths and weaknesses and like how to encourage it. Like the actual like really deep personalization that I think it like before historically, I think it's felt like it was a lot of work to try to get that as a user. And even then it wasn't that good, but I feel like now it could be really good. And so I think companies that demonstrate that and lock people in that way, like the utility piece is going to be forever changed. Network effects are always going to be really powerful. They're really, really hard to create. You need to probably start with utility to get to network effects, right? Because like you need some way to jumpstart the network. In the age of AI, though, it's a little bit complicated because you also have inference costs. When Facebook first took off, it was like there was a lot of infrastructure costs. So maybe it's and then those came down over time. So it's kind of comparable to that. But I suspect that it's even more expensive now. Like if you have a very like inference heavy product,
it's easier to consume, right? Like Facebook needed that inference or needed that like data center build out because they had so much users, right? But before you had users, the cost was low. But now it's like even to get off the ground, like the cost per user is I think much higher than it was during the Facebook time. They just had like much bigger scale because it was a free product.
And we don't even see the labs are just absorbing enormous amounts of that, right?
So yeah, they're subsidizing. I mean, LPs are, right? Like basically the investors in those labs are eating a lot of that cost now.
Yeah.
We're not struggling, but like RevenueCat is integrating a lot of AI features now. And even we're, having to be like, well, there's cost decisions that go into these things, right? And even at our scale, especially for like speculative features, like, oh, would this be valuable to a user? Can we afford to do this for every user every day? And we're not talking about like crazy stuff, but if we wanted to make one LLM call like per app per day, that would be like tens of thousands of dollars a month, right? Like that's a non-trivial investment for like a small feature,
But it will come down. It will come down.
Will it? I hope so.
Yeah.
It may get worse before it gets better, though.
Yeah, I know. Yeah. Opus has not come down in 6 months. So like, I'm a little bit like skeptical right now. But nobody's made a comparable model to Opus, right? Like,
No.
I think 5.5 is comparable, but it's not quite the same.
Yeah.
So like, there seems to be enough differentiation that they can maintain pricing power.
I had this thought the other day where I was like, you know, because part of the discussion now is, well, use, you know, dumber model for a simpler task and, you know, do all that sort of like routing and stuff. What my experience has been when I've done that, I'm like, once you taste the good model, like I can't,
it's like, I want to use it for everything.
I can't because it will still sometimes screw up even trivial tasks. And I'm like, I don't trust the outcome, or like it makes mistakes.
Yeah.
And so I do want the best model for everything, which is really expensive. But at some point, you know, it actually will become true that,
yeah, I mean,
a more basic, cheaper model is sufficient for a lot of the stuff. I'm not sure we're actually there yet.
You can use CPUs as like maybe a crude analogy to this, which is where like, you know, for the period of 1987 to 2010, like every CPU bump was so critical and important, and you always got the fastest CPU because it really mattered. But then in the 2010s, it kind of became that all CPUs were pretty much fast enough, and like it became like a much less interesting differentiator. So at some point, we will be so saturated on other bottlenecks or whatever that it won't matter anymore. But yeah, I mean, as soon as Fable came out, like 2 weeks or whatever that was, with a brief period it was out, like I upgraded all my percentage because I was like, yeah, I'll pay twice as much. I don't do that many queries for my high intent, like, you know, stuff for like my open call running. I'm not going to put that on the highest and most expensive model just for price reasons. Backing up, I have to agree that like price will come down. We'll build more data centers. The current technologies, we're not even like super, like we've not even gotten super efficient on how we do inference today. There's a lot of optimizations that can be made yet. So between like just capacity improvements, other smart optimizations, like the price and just like basic economics, right? Like models are amazing, but they're not actually that differentiated, right? The only company that it seems like right now is like, it's the NVIDIA, TSMC, and ASML are like the only companies that have like unreplicable technology in this stack. The models themselves seem like, you know, it's just oversimplification, but you get a big pile of data, you pre-train over it, you RLHF it, you'll get something, right? It's like,
well, that's why they're so focused on finding differentiated data now. That becomes the thing.
I think you're both right that it will eventually come down, but when you're making a financial bet, you also have to be right about timing. And so if you're going with Fable, you know, rumors are it might come back this week. And if you're building your business around Fable and it takes 5 years to get a Fable level model at more reasonable prices, that's a very different business outcome than a Fable level model in 2 years, in 18 months, and guessing at that time horizon. That's what so many people are doing right now. Is we're doing it at RevenueCat. Like we're using Opus 4.8 for our Rico product. It is amazing. I've been shocked at how good it is at those things, but we're making a bet that like that will get cheaper, but how quickly will it get cheaper? And then how's the usage going to go? And like, everything's just a bet.
Explicitly killed us. We were starting to build some like cost control measures, and I was like, nah, like that's what the venture capital is for, right? It's like,
that's what I was just about to say. Like this is where venture capital is actually useful. Like if you are building a business with network effects, let the VCs bet on the fact that the cost of inference will come down if it's expensive, but like people are addicted to a product that's essentially growing virally or something. Like that's the use case to go get the venture funding, to be like, okay, we have an amazing product. People are totally addicted to it. It's growing super, super fast. However, like there are these like really high variable costs right now, and everyone believes at some point they'll come down. And like, as long as we're growing, keep, you know, pumping money.
Yeah, I mean, this is the bet that the model, the core model company, I mean, the biggest venture round, private investment rounds of human history by far margin. Because of that, exactly, like they all understand like the winnings. I mean, that's the other aspect, Andrew, to the, you know, go get the venture capital if you have these like cost of scaling things. The eventual prize has to be big enough because these folks want to make money. I imagine this is as an investor, making money is important to you. Would you say that's fair?
Yeah, I mean, that's LPs tend to care about that. Yeah.
So LPs, that's another thing. Did you know this? I think probably everybody knows this, maybe not. But like, so this is when you invest, it's all of your money, right? It's like Andrew's personal money. that you invest? No,
No.
is that not true? No?
Yeah.
Whose money are you investing?
LP's money. Yeah.
LPs? What's an LP? A limited partner,
A limited
right?
partner. Yeah. You raise a venture fund from people who invest in the fund. They want to invest in startups, but they aren't experts at that. So they invest in a fund instead. The fund invests in the startups. And so it goes.
I did
And the
not know that when
LPs
I raised my first venture investment, by the way. I did not fully understand that dynamic. A
interesting.
little bit, kinda, sorta, but like didn't really understand.
The LPs in 2026 are seeing the SpaceX outcomes. They're seeing the Anthropic and the OpenAI outcomes.
Well, they've seen the last 3 Anthropic rounds, and they're like, "Why am I doing seed investing? Why don't I just try as hard as I can to get my 3x my money in just like mega Anthropic round?" Like that's the facts on the ground right now. I think it's probably affecting every stage of venture right now. Like I would say, even early stage is just being like, "Why the hell don't I just write into the next OpenAI round?" But that might be over actually.
Well, I also, so there's this other, I mean, this is getting like a little into the weeds on venture, but like there's also this multi-layer SPV thing that happened, right? Which is like, okay, yeah, sure, I want to invest in Anthropic, but turns out I don't know Dario, probably not getting on the cap table, but I can invest in some fund that invested in a fund that invested in a fund that invested in Anthropic. And then like each of those funds has
You get to
like
learn how fees compound.
Fees. And then, so they're classically happened with SpaceX. And there are a lot of people that just like, their returns are diluted down to nothing, or they don't even know like who's managing the money on top, like above them. And like, it's a very dicey game to play.
This is why we have these highly regulated public markets at the late stage, because like the bad behavior, not to say bad behavior, but the lack of transparency causes real risk, but not the kind of risk you should take in investing. Like it's like
no, it's the wrong
or
kind of
procedural risk, not like actual venture risk. To this money making point is that like, and it's a point I wish I had known when I did. It ended up working out, but like I had somebody slide into my DMs like this year who had an app, had like a few $1,000s in ARR or MRR, like was doing okay, was like starting to take off, and it's like, I want to raise money. I was like, no, you do not. And I asked him, I was just like, okay, so tell me how you sell this company for $1 billion. And they're like, well, this and that, coming up with like extreme, more grasping for straws. And I was like, okay, unless like that is your goal and like you're going to do nothing but focus on that outcome, do not raise venture capital. Like all it will do is like limit your options and make you miserable, and like you'll have mad investors. You know, if you give good investors, it'll probably be fine. Nobody's going to jail, but like, it's just going to make your life hell. And luckily, I don't think somebody like that would probably accidentally raise venture, right? Like, I think it's like venture capitalists are pretty good at not making those bets. They can read that. But like, I do think it causes a big distraction. I mean, see people like obsessed with applying to YC. I don't think it's necessarily, you know, YC's great, whatever, but they're tooled for you going for that $1 billion, $10 billion, $100 billion outcome. So like, unless like, it's not going to be as important or as effective for you if you're not on that trajectory. And back to your point, Andrew, we've never been in a better time for somebody to build a company that like an app company that's going to make $10 million a year. And like, as a founder, you talk about like founder outcomes, like
amazing.
You've seen it. Like just because your company raised money and had a bigger outcome and a higher valuation does not mean you as a founder did better.
Well, even just understanding like preferred versus common stock, right? It's like if you raise a $20 million Series A, those investors get preferred stock. If you sell your company for $20 million, they get all $20 million.
Yeah.
Right. Like
they get paid first. Right?
Investors are more protected than founders in downside scenarios.
And so depending on the way it's structured, it could be a 2x liquidity advantage or a 3x liquidity, where if you sell it for 40 million.
You rarely see that in 2026.
In like San Francisco round. VC, but in like Austin VC and like in other markets, you do still see this kind of liquidity.
For the listeners out there, if you get a term sheet with anything but a 1x preference, do yourself a favor and don't take it unless you're desperate.
At the end of the day, you should like actually believe that you can build a multi-billion-dollar company to go raise venture, because like there is actually another credible path now, because like you don't need to go hire a bunch of engineers. Like you can vibe code it, be like really thoughtful about your product, and like you can build a multi-million-dollar a year business with no venture, own the whole thing, and like That's awesome. And like, you have to respect what type of business it is. It's not just like, what do you hope it could be? It's like some companies have the space to become massive if you execute really well. Others you can execute incredibly well, and there's just still not going to get that big. So just like align the capital strategy to reflect what type of company you're trying to build.
And including not just cash capital, but like your time and like not just like your hours, but like the years of your life. If you're going to spend 5-10 years on something or 2 years on something, like know what your possible best outcome is and make sure like that's aligned with. I won't disclose too much, but I just spoke with Curtis from Slopes, who we've had on the podcast, and he famously bootstrapped. I think they're like, I don't know, 12 people now. I don't know. The company's in every year, he just like reinvests and keeps going. And it's like, he's built a really amazing business and he's very happy with like how it is, right? He's built a great product with a good team and like they have space to build and like probably maybe could have done a venture thing if he wanted to do that, but like was very conscious. He did a very like thoughtful and conscious way of like choosing how to build that business. That's the kind of like thoughtful decision making people should be making.
To David's point, it can change later, right? Like you can build a $10 million business and then realize like, wow, we've earned some insight into where the multi-billion-dollar company actually is. Now we'll go raise to tackle that.
And you're at a higher valuation, less dilution.
Like your terms are gonna be awesome. But like I think there are other cases where it's like, hey, we're gonna swing. We're swinging like for some massive thing. Like we know the market is huge. We know it's gonna be expensive to build. And then sure, like go raise venture.
Is there a middle path? Or should there be a middle path though? Where like, I mean, even with my little vibe coded app that I've been working on the last 3 months, like I've probably spent $1,000+ on my $200 Anthropic subscription and my $200 ChatGPT subscription. And I put $1,000 into UGC and I wasn't expecting a big outcome on that, but at some point you do need some money. Like these things aren't free. To get the ball rolling with scaling, you probably do need $10,000-$20,000 to be investing, like, and that's on the way low end. Like if you're going to try and scale paid ads, you need probably a couple $100,000. Like, is there a middle road for products that are showing traction but aren't venture scale but can move fast? Like Curtis, that's a great example. Like, could $300,000 4 years ago helped him shortcut 2 years of slow growth and pain? And like, should there be a product for that? What's the middle road?
I think that there's an opportunity for a new sort of like venture lane to emerge that takes advantage of what you're describing.
Or just a new class of capital, not so venture,
it's just and I think it makes a lot of sense because I think it is going to be a lot easier for a bunch of reasons for talented people to build these like multi-million-dollar a year apps. And maybe it's something like small checks with like a profit share. The idea is to build like a cash flowing business, and it's, venture is built around the power law. So like this would not be a power law.
You have to finance your 9 losses for your 1 win. That's why venture needs those outcomes, because five go out of business, 4 1x, and then 1 returns all the money.
You need mega outliers, but I think that I suspect that there's a strategy around generating like seeding really strong developers that generate cash flowing businesses that aren't going to require additional capital, or that's not the plan anyway.
The funny thing is those existed, and all the ones I'm aware of actually stopped that kind of investment in the last 2 to 3 years. Tiny Fund, NDVC, Calm Fund, 3 off the top of my head that were doing almost exactly what you're saying. And maybe they just bailed at the exact moment when that curve would have bent the right direction for them.
I don't know. I'd be curious what Andrew thinks, but in an era where the S&P has been just on a generational rip, it's really hard to get capital to go into anything but treasuries and the S&P. You know what I mean? Why would you bother? And it's not just the return expectations. It's how long do you take to get the return? There's also the risk, but say you get the risk right. Managing private investments is just a pain compared to just having your money in your Robinhood or your Fidelity or whatever, and having some very basic money investments. And that's what you're competing with, right? And even a good venture fund, Like a great venture fund, you know, they 5x the fund in 5 years, something like that. That's like an amazing, but like most venture funds aren't. Those are like the outlier returns, right? I think in venture, if you can beat the risk-free rate of return, you're at least like above water, right? And like a lot of them are probably close to that. And so it's just hard. Like those dollars are fungible, and like you're competing, you know, unless you just really believe in the thesis, you like the idea of it, you're advocacy investing. You know what I mean? You're investing in something because you believe in it, not for like purely capitalist reasons. But at scale, capital will just flow where capital is grown the best, right? And so these things have to like really compete. But I'm with you, Andrew. It feels like, and I don't know what the structure looks like, because we have debt. Is there like just are we looking at like specialty lenders that like understand these businesses better?
Maybe it's the RC venture arm.
Yeah. Well, I mean, yeah, we're talking about this now. Like, we have daily payouts, which is like a factoring product, right? In theory, like we're not far from being able to build debt-based products where like we loan against your current run rate. But the thing with debt is like it's debt. You're borrowing against your future. Right. I guess there's two differences between debt and equity. But debt, like you're borrowing against your future, which is kind of true for equity as well. Because when you sell equity, it's like, hey, you're selling a share of all future profits. Like when you sell equity, like you're cutting people into a share of all future profits. The difference with debt is like the profits capped that you have to give out, but they also have like downside capture. So like they get your business if it goes the other way. Right. Versus equity is like the upside's uncapped, but the downside is capped, right? And there are combination products, like venture debt is like a combination product where it's like, it's debt, but it also includes like some warrants and things like this on equity. There's like no free lunch, right? If something is like a good return on capital, it will exist as a product probably eventually. If something's not necessarily a good return on capital, maybe it won't, would be my guess. But yeah, I mean, why would something like a RevenueCat, like us falls in that like specialty lender, specialty financier, and like industries have these, like, I'm not certain of this, but I'm sure like oil and gas has like specialty banking that like understands their specific needs. I'm sure, just name your industry, there's like a specialty lender or banking or investment arm that like helps, like understands these industries better and can like underwrite them, right? It's even in venture, like venture funds have their focuses, right? So because they can understand those businesses a little bit better and make better bets.
It could also be just a studio that adds a lot of value too.
Well, actually, Bending Spoons is maybe a great example of this, right? But that's later stage. It's financial engineering, but like plus operational engineering. It's like halfway between a private equity fund, like roll up, and like an operating company. But yeah, maybe that exists at the earlier stage. I don't know.
There is an interesting financing product that I became aware of just in the last year when Ladder used it, is General Catalyst Growth Fund. That's a really fascinating model. You've looked into that, right, Jacob? So it's essentially debt, but it's like user acquisition financing where they fund up to 80% of your acquisition. And then like structurally, the way it works is they do it based on cohorts. So like if in January you spend $10 million, they'll finance 8 million of that. And then they track that January cohort and they get repaid. In their case, I think it's only a 10% annualized interest. They get paid back out of that cohort's earnings. If that cohort takes 3 years to fully pay it back with the 10% interest, it takes 3 years to pay it back. The nice thing about that is it's not dilutive funding, and two, it's not a recourse loan where they're going to come take your house.
It's not actually debt in that case.
It's not an indie putting it on their credit card where if they get too far upside down on their credit card, like they're going to be in trouble. And so that is interesting. That one is only available to much bigger apps, much more proven, much more. But there's probably room for that type of a product to exist on a smaller scale as well.
I would be really curious to know, and this is without any insider knowledge. Again, it's 10%. It's like, why would they go through all that trouble when the S&P is making nearly that? You know what I mean? Like, you gotta set that up. You gotta bear. There are some risks involved, right? They have to finance the losses in that interest rate.
Well, they set up that fund when interest rates were only like 3%, and now it's more like 6%. So like things look different. Like cost of capital is different, return on investment is different.
General Catalyst.
Yeah. So it's portfolio value add to win deals. right? Like,
Oh, on the equity side, right?
Yeah.
Which then in that case, it's a hybrid product, like equity plus debt, right? It's
Yeah.
almost like a venture
I mean, I'm
debt
not
style
familiar
thing.
with it, but that's what would make sense to me.
Yeah, that's what I mean. These things all like sort of flow to like what's the risk-free rate of return given a time and the interest rate. Like those are like, this is really affect these things, which when you're starting out, you don't, David, it was when you were talking about like, oh, I put a couple thousand into this, a couple thousand into that. Like you have the benefit of like having seen like, you know, scaling an app up and kind of understanding like the cash flows. There will always be an initial capital investment needed to get something off the ground. It is, I think, precipitously lower than it was 2 years ago, 5 years ago. Now, that's also because of that, competition has gone up a ton. So like everything's getting more expensive. It's going to get more expensive, and potentially like the flow of dollars you're competing, you know, there's fewer. Like I guess that is just competition, right? Like you're also competing over all these adjacent things. So like ad spend, you're competing over the same eyeballs on the Facebook's networks and all these things. There's all these like sort of effects. I have not gone deep on analysis, but I've been trying to like think about what is going to happen in the app ecosystem as this stuff plays out. And I think we've seen it is, yeah, there's like just going to be more competition. It's going to be tougher. The dollars on the supply side, I don't think have necessarily gone up. I don't even know if we would have a way to easily see that. We'll get numbers from like app figures and stuff like this towards the end of the year, Sensor Tower towards the end of the year on like total consumer spend. But I'll just say, from a naive analysis of our macro data, it has not seemed that like spend has rocketed up in step with the amount of like new apps we're seeing be created yet.
This sort of comes back to where we started, which is like, I still think we need better tools to help people make better products. Like we brought the cost of building down, but we need to bring the quality up on average.
This has been also why I keep asking people, and I'm like keen to see, because like even if the quality just stayed the same, the number went up, like let's say we doubled the number of apps, quality stayed the same. If you could measure quality by some abstract number, like you would have twice as many outlier great apps, right? Like you would think, unless I think
the same.
Right. Well, I mean, unless yeah, like that assumes that quality stays the same, which basically assumes that there was bottleneck on engineering was the only bottleneck, right? And that like engineering or like development costs drop, suddenly like all this like excess of taste or whatever can flow into the app store. There's certainly excess initiative. I'm convincing myself of your point, Andrew, is that like there's now plenty of initiative, but is there like actual ability? Maybe to some degree, yes, but maybe not universally.
But I think people can learn.
Certainly.
That's why X1 is cool, because people can learn.
I think everybody who's made a great app made a bunch of bad apps before that.
Yeah,
usually.
Exactly.
Like it's rare that somebody is just like born. I'm sure there are counter examples, but like, you know, it takes a lot of years of using software and getting opinions and
talking to
bad
users,
apps.
Talking to users, right?
Yeah.
Like you have to be able to iterate a ton. So like whatever is built has to be set up to be iterable.
Yeah, which is the case. I mean, the cost of production has gone down, but so has like the cost of iteration. Like all of those costs have gone down.
Do you get signal from like average ratings across the whole app store?
It certainly exists.
That is actually a very poor measure of quality, unfortunately, because so many apps are gaming it. I mean, this is actually something Apple just clamped down on in the last week.
Which would change the numbers drastically, right?
The fact that they're apps have been, and I mean, I've had this question for a long time, like, why are all these apps who like seem like really crappy, like why are they 4.9 stars, and my indie app that I've like poured my heart into for a decade is 4.5 stars. And the answer is, when you ask in onboarding and you prompt right, you just get a volume of people who just don't even care and hit the 5-star and hit submit. So unfortunately, the star ratings are so gamed at this point that like it's a very poor quality signal. The one interesting thing, I think Ariel from App Figures was doing this. He devised some ratios of the star rating of written reviews. Like what number of 1-star written reviews do you have compared to the number of 5-star ratings? Because it's easy to get somebody to tap the little 5-star thing and hit submit. It's a lot harder to get them to go like actually say something good and meaningful about the product. That's game to some point too, where like people are still buying reviews and things like that. But Apple's cracked down on that quite a bit. So it's harder and harder to actually fake their written reviews. So that may be a better kind of signal quality adjustment, is to look at written reviews and do some ratios there.
I'm glad to hear they've cracked down on it, because at the mine company, we had some blatant copycat out of Eastern Europe that clearly just like bought a ton of, ratings and reviews. And we like collected a bunch of evidence and sent it to Apple, and they just didn't do anything. But if they've cracked down on it now,
3 years later, they cracked down on review farming. It's progress. Andrew, I think it's probably just like total spend. You know what I mean? Like that's probably our best. Well, there's you gotta like probably per capita, probably like divide that by like, humans on Earth or something like this.
I mean, it's always retention though. Like, can you see like retained spend, non-churn, like churn, some indication of churn?
Yeah. Well, that'll measure existing players. The last 2 years, the answer has been yes, which is like, is there more software functionality that can be extracted from phones specifically, but just in general, like personal usage of software? Like, is there more depth than we had pre-AI? And the answer is, well, absolutely yes. Like, I don't know if it's 2x, but I feel like it's a huge increase in like how and what people are doing with computers than they were 2 years ago. And that was just a factor of making computers smart and letting them talk, which is no small feat. But it kind of, do we think we've hit bottom? Like, and that was like, okay, that now we're actually maxing out what humans can do with computers. It's like, probably not. Like, there's probably more depth to it. Will we hit, like, LLMs were just such a like step function across everything. Like, they made almost everything better and faster in many different ways, both in like what's in the apps, but also how they're made and all this other stuff. Now, that's not the same level of innovation that we're going to have. Again, talking about like a tasteful entrepreneur, like making something that's a very small like needle point, like in the total value of apps and humans using software. Like, as they attack a niche, and they kind of, again, I'll go back to ATC, this app I've been really enjoying. It's a very well done app that like in theory could have been built a while ago, but nobody did. And it's like a fresh take. And I have to think that like, and it's doing well in the sense that like, I see it everywhere. People are talking about it. It's become a thing. And I have to think that's still possible. And even in chess, like even in like these like long, even in Strava's category, right? Like I have to think that there are unique things to say still.
For sure. Yeah, absolutely.
But the chance of finding that is so like infinitesimal that like going back to the venture thing, it's like that makes it a very, very hard venture bet.
Well, it's also just like hard to disrupt someone else's network effects. But I'll tell you two things I'm not worried about. I'm not worried about like apps not mattering anymore because everything agents. Not worried about that at all. And I'm not worried about everyone just building their own bespoke software for everything. But both of those things have come up as like major threats or topics or whatever. And I just think there's no chance of that. One of the classic mistakes in a venture-backed business is you get some company, they're like crushing it. They're super confident. They're growing really fast. And then the CEO's like, I don't like Salesforce. We're going to build our own CRM and it's going to be better, And then it becomes like a total boondoggle, right? It's like the same thing. Like, let someone who's totally focused on making a thing great, make that thing and then use it. And maybe there's more of a personalization layer on top of that. And I've built software for myself, and I think everyone will do that to some extent. And that might drive down the cost of like buying it off the shelf, which is good, I think.
Yeah, it competes with the incumbents, like the actual commercial
it can't be outrageously expensive anymore.
Yeah.
But like people are still going to want to use products that other people create. And then secondly, the form factor might change, but like people want like beautiful visual experiences. It's not only going to be agents talking to each other. That's going to be like under the hood. But then people want to interface with something using their eyeballs.
Yeah, something that's tasteful, that's artistic, right? At the end of the day, somebody was talking about the Vision Pro and how like if we were at software maximalism already, like the Vision Pro had some really cool, I've never actually used one, so I should shut up, but like had some really impressive demos, right? They have this like dinosaur wall demo. These are amazing experiences that are like very short, right? They're very like minimal. And if we were at true, like if AI was truly replacing, like you would have like these like insanely deep experiences on these niche platforms, right? And it doesn't feel like we're there or even close to there, or like anybody's even working on it, right? The bottleneck does not seem to be just like purely like the ability, there's a lot of pipeline stuff that goes like, we're not at visual rendering capabilities for like asset creation on these things and stuff, but a lot of bottlenecks still. And to be honest, like sort of at the beginning of Opus and the new model wave, I was like, oh, kind of like is software. And like we've seen certainly parts of our software have become less compelling than they were pre. But yeah, I mean, at the risk of saying like, oh, of course my business will never be disrupted, but like, I think I've come around to the same sort of belief.
Well, on that high note, let's move on to the lightning round. There's 3 questions I ask every guest when I remember at the end of the podcast.
So by some definition, every guest.
What's the most impactful experiment or change you've seen this year? Not operating apps yourself, maybe in a portfolio company or across the industry. What's the most impactful thing you've seen this year?
Okay, I'll give 2 real quick. I will give one for myself, which is that I started building like my own CRMs and like productivity tools. But the impactful part is teaching them to like learn and improve. That's what I use Zoho Computer for. Basically, like I have a CRM, I have a to-do list. It's all connected to my email. I'm not an engineer, so I'm not going to like blow myself up like I would using OpenClaw. But then I actually have it like evaluate its own performance and get better on like crafting priority to-dos for me. And that has been really, really cool. And I'm just like excited to see what happens in software in general with those sorts of techniques. And then I have a portfolio company that built like their own internal analytics tool that's just like ridiculously powerful and anybody can use with natural language. And so that's one thing on the portfolio side where I just see the democratization of like analytical capabilities within companies is super, super powerful. And I think will lead to like more velocity and better decisions. So those are 2.
This is like a whole nother pod, so I won't fully chase this rabbit and go down this rabbit hole. But my biggest concern with the internal analytics stuff is, and I've heard from people who've had this issue, is like data quality and like the relying on the answers you get out of your internal analytics pipeline is scary to me.
For sure. I think you have to put a lot of effort into making sure it's good, right? So it's like one thing to set it up. It's another to improve it over time, so that it actually like understands your data structures and you don't have the garbage in, garbage out problem. But if you can get there, which I do think is possible, then you do have a natural language analytics tool. That's just like not having the bottleneck of data analysts and data scientists or asking like full stack engineers to like run SQL queries for something. That I think that's a game changer for companies.
Yeah. I've been using Amplitude's AI for my product analytics and Rico for my RevenueCat analytics, and it's pretty dang good.
We got to get all these folks together. We should have a big chat room where we add all the agents and let them talk to each other.
All right. What's the worst experiment, the biggest fail that you've seen in the past year?
I've seen a number of like security related incidents, and I think this is just a byproduct of like moving fast with AI. I think people need to be like conscientious about what vendors they use as well, right? And like, how are their vendors thinking about governance? Do they have, or is it just like max velocity ship code? The industry is going to figure this out. And I don't think the right answer certainly for a company is to be like, oh, we're going to be conservative and like go slow because you're just going to get crushed by the competition.
Yeah.
But I have seen like multiple serious security incidents that I don't think would have happened pre-AI. And so I just think it's something for like general cognizance and awareness and like thoughtfulness around the trade-offs, both internally, but then also in terms of like the tools you use and like what are their principles.
Yeah, that's a really good one. Last question. Growth would be easier if...
Yeah, okay. So we talked about this earlier, but I like inference costs coming down. Like
that's a great one.
Yeah,
that's
just
a
like
great one.
Like super cheap inference that's really high quality. I think it's just gonna feel unbelievably magical. And I agree, like it does seem like we're kind of going the other way right now. I think, probably the best models are like, we can't just light money on fire forever. But I do think, there's gonna be like more model routing. There's going to be more building of local models. There's going to be like better, physical infrastructure and all these sorts of things. It's gonna come down. I don't know exactly when or by how much, but I think that's going to unlock an enormous amount of growth.
Yeah, such a great answer. Thank you so much for joining. This was super nerdy, but super fun. I don't think we've ever gone this deep on venture capital before, even like explaining.
We had Andrew on twice. We did a 101, we had to do a 102. You know what I mean?
So this is great. I think people take a lot of value away. So thank you, Andrew, for joining us.
Yeah, thanks for having me. Good to see you guys.
Thanks so much for listening. If you have a minute, please leave a review in your favorite podcast player. You can also stop by chat.subclub.com to join our private community.